Hello students. In this video, we will look into an interesting application of LPP in finance domain, which is portfolio models and asset allocation. In 1952, Makrovich showed how to develop a portfolio that optimized the trade-off between risk and return. His work earned him share of the 1990 Nobel Prize in Economics, and his famous paper is also available. If you can just Google it in on Google Scholar, you will get hands on his paper. So the case goes like this: a portfolio of mutual funds, Hawk Investment Services designs annuities, plans, and other investment vehicles for investors with a variety of risk tolerances, right? Hawk would like to develop a portfolio model that can be used to determine an optimal portfolio involving a mix of six mutual funds. So now if you see here, there are six mutual funds here in this table. First mutual fund invests into foreign stocks. Second one, intermediate term bond. Third one, invest into large cap growth vehicles. The fourth one is large cap value shares. The fifth one, small cap growth shares, and last mutual fund invests into small cap value shares, and their yearly returns under five different scenarios, because some years can be very optimistic, some years can be very dull. So there are five scenarios they have considered, and under each scenario how these five mutual funds have performed with respect to their annual returns is given here, right? Now let us look at the conservative portfolio. So in conservative portfolio, basically what happens is that the investor wants to get return which uh, is assured to him in all the scenarios. He wants a particular return in all the scenarios, and then we want to maximize such returns. So in this case, the we will start with first declaring the variables. Let Fs be the proportion of portfolio invested in the foreign stock mutual funds. Let I be the proportion of portfolio invested in intermediate term bonds fund, and so on. So when you just, because these are all proportions, they must add up to 1, because the entire amount which the customer has to be invested into the various mutual funds. So that is why all this will be adding to 1. Then under first scenario, when we invest Fs, it will be, the returns will be 10.06 times Fs, then plus 17.64 times IB, and so on. So the first year returns are given here, right? When you add this, it will be first year return, this will be second year return, and so on. And you want a particular minimum return which is termed as M, and in all the scenarios you should get at least that M or more than that. So that's how the conservative thinking works, that I want assured returns of minimum M, and every year I should get either that or more than that. So that's why like this we can formulate that. So by replacing R1 R2, we can write like this, that this is of scenario 1, I should get more than M. In the scenario 2 also I should get more than or equal to M, basically. So now to develop the portfolio, we have to maximize this minimum. So that is why it is called as maximizing the minimum, and it is also called as the maximize the value of minimum or maxi min model. You can see here maxi min model, and the entire model will now look like this. This is my entire model, right, from here to here, that maximize that minimum returns which you want the investor has to be assured, and this is what it is going to be there. So these are the constraints for each scenario, and lastly all this proportion should add up to 1, and all my proportions as well as my return should be greater than equal to 0. We don't want any negative return. So when you run this model on the Excel solver, we will get that uh, M value. So if you see here, we are getting that M value somewhere here. They have must have mentioned um, here. So if you see this, this is my return M 6.445. So in this scenario, we can assure 6.445 as the return. The minimum return will you will get in whatever scenario repeats in the coming year. Okay, and for that you need to invest uh, this one. So 6.445 is my return, and you can these are your investments. You have to invest 55% of your investment into IB, nothing in FS, 13.204 into LG, 31% into SV. So these three mutual funds you will not buy anything, you will not invest into this, but these three you will invest your entire money, and finally you will get 6.445 as the return, whatever is the scenario in the coming year. So this is your conservative portfolio. And further going there, basically if uh, the the person or the investor ready to take a risk little bit further. So if you can go little bit further, say that he can say that okay, I want little bit more returns, but I don't want to go below 2%. So by setting m equal to 2 minimum return constraints in this maximum model, the the model will get converted into something like this. Here if you see here. So in this case, your returns will be greater than 2, R1, R2, R3 in all four scenarios, and we assume that there is equal probability of the five scenarios happening. So we should assign probability of 20% to each scenario, right? So expected value of return, because whenever we calculate in such cases expected value, it is probability into the return expected. So 20% or zero point 0.2 into R1 plus zero point 0.2 into R2, etc. So this particular return you need to maximize. So maximize this return and let these returns are R1, R2, R3, R4, which should be greater than equal to 2, right? Greater than equal to 2, greater than equal to 2, greater than equal to 2. And then, so basically, when you add all this, you should also get equal to 1, which is obvious thing. And these are the non-negative constraints. So when you do this change, then what are the returns you are going to get? So this is called as the moderate risk portfolio. So if you see this, this is the moderate risk portfolio. You will see that your returns are, if R1 happens, you will get 29% return. If R2 happens, you will get 22% return. If R3 happens, means the fourth scenario, you will get 31% return. But in the third scenario, you will get the 2%, which the customer is ready to go up to below as below as 2%, and in R5 also he will get 2%. So out of the five scenarios, three scenarios are such that you will get very high good returns, 22%, 29%, 31%, but in two scenarios you will get 2%. So this is how you are. So basically the optimum value will be 17%, but please understand one thing is that the 17% never will be the actual value, because out of these five any one scenario will happen, and this is what you are going to get. To show it as an expected value, we use this concept of probability multiplication by value, but always in reality one of the scenarios will happen. So overall we can say that the return is 17.33, but customer is never going to see 17.33 as the total value. He will either see 29 or 22 or 31 or 2. So this is the moderate risk portfolio, which is a modification of conservative rate portfolio. So if somebody wants instead of 2, he will say 1% is okay for me. Then the values will change. If somebody says no, no, not 2%, I want 4%. Again, you will have to change the values here. So depending on the requirement of the customer, you can put these values here and rerun the entire model and get new values of this investment, because to get this you need to invest 10% in your LG here, 41% into SG, and 41% into 47% into SV, whereas FS, IB and LB will not come. So for any new requirement, this combination will keep on changing. So this is your moderate portfolio, and this is what the two variations we have. The Markovitch theory, we will also go into non-linear. It is a non-linear application which we will take up into my future videos, where we will go into the Markovitch portfolio theory, where the requirement will be non-linear application. Thank you.